You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. Today's podcast, we have Jeremy from SemiAnalysis on. This is his second time on the podcast. He came on in February. We talked all things semis and particularly power then. We dive into all things power now. I think it's a really interesting conversation for someone who is, I mean, if you've ever seen the SemiAnalysis stuff, deep in the weeds, but it's going to touch on a lot of things, whether you're interested in, NVIDIA YOLOs and CoreWeave, or whether you're interested in just kind of the demand for power, the outlook for natural gas, the outlook for natural. We're going to touch on a lot of different stuff. I think you're going to be really interested in it. We even hit on a little bit of Oracle and Larry Ellison, who I've been a little bit obsessed with since the book club on Oracle. So we're going to get to all that in 1 second. But first, a word from our sponsors. This podcast is sponsored by Portrait Analytics. People ask me all the time, what's your favorite stock screen to run to look at for ideas? Is it low price to earnings, high dividend yield? What is it? And my answer is simple. I don't run screens. I somehow doubt that there's serious alpha in sorting through stocks that are trading under 10 times price earnings on Yahoo Finance. But Portrait Analytics has completely changed the game on screening. It lets you create bespoke screens to generate actual unique ideas. Let me give you an example of one that I've been using recently. I wanted to look for stocks with greater than 200 million market cap, where the company has publicly discussed trading at a discount to peers, and both the companies and insiders had been buying shares on the open market in the past 12 months. To me, that's an interesting screen. It's unique ideas. It's a blend of quantitative and qualitative. It's pulling things that aren't, just purely numbers based that the insiders are talking about. And it's building something that kind of fits with my view of the world and my view of the types of stocks that would be interesting. Portrait let me find a handful of companies that meet that criteria. The last time I did the screen, by the way, the screens run every day if you want them to, every week if you want them to. The last time I did the screen, it had 4 or 5 stocks that exactly hit that criteria. And then boom, I had a list of really interesting things that I actually might buy that I could sort through. It also showed me exactly where the company was talking about, how their valuation compared to peers. So I could see, hey, was this a one-off, or are they consistently talking about it in a way I think is interesting? Anyway, I think it's completely changed the game for screening and for generating new ideas. If you're looking to up your screening game, you should check out Portrait Analytics at portraitanalytics.ai. I'll include a link in the show notes. All right, hello, and welcome to the Yet Another Value podcast. With me, I'm happy to have on today for the second time, Jeremy from SemiAnalysis. Jeremy, how's it going?
Hey, man, good to see you again. Thanks for having me.
Look, you've got an open invite. Your last pod was actually, I never reveal stats, but it was one of the most popular podcasts we've put out this year. YouTube stats were great. I don't know what it says that the audio stats were even better. I don't know if that speaks to my face, your face, whatever it is, but both the stats were great, but audio in particular was off the chart. So the people loved it. I'm super excited to have you back. I want to dive into all things SemiAnalysis after I just remind everyone. Quick disclaimer, not investing advice. We're going to talk about a ton of stocks today. See the full disclaimer at the end. Jeremy, you and I were just wrapping earlier today. Obviously, I think our conversation is going to cover everything, semis, power, and everything. But I'd love to just start kind of in the semis and power space. What's the next big trade in the semis and power space, I guess, is the headliner.
Yeah. Disclaimer again, not investment advice, but definitely I think one of the interesting things that you're seeing is the surge in on-site gas. And I'd say a lot of people talk about deploying CCGTs to power data centers, but there's an issue with those. It's the lead time. Everyone knows there's a multi-year lead time to get CCGTs. Maybe what people don't realize is that actually you can deploy at very large scale, much faster, smaller units, more modular units. So you have 2 types of systems. You have the aeroderivatives, which are turbines, mostly sold by GEV and CAT. And you also have basically huge car engines. It's called RICE engine, reciprocating engine, supplied by folks like Voltogrid, also Caterpillar and a few others. And in both cases, we're increasingly seeing, I'd say, solid, reliable data center projects that I believe are going to be operational in 26, 27, serve some very large end users like AI labs and hyperscalers. And I think they're going to be deploying those technologies. So basically, if you think about what's the market for on-site gas for data centers, in 2024, it's pretty much Elon Musk. It's pretty much the Memphis site. In 2025, Elon Musk again is a driving force. So in 24, you had like 300 megawatts of on-site turbines, or 250, whatever. 25, he's probably adding another 500 to gigawatts on-site. But you have other sites. Another one that's well publicized is the Stargate Abilene, Texas site, which is going to deploy 360 megawatts of those GEV aeroderivatives. But there's more, actually. I can't talk about all of these sites. If you want to know more, subscribe to the data center model.
That's a fantastic pitch. And look, I was just reading some stuff to prep for this podcast. And if you have, I mean, SemiAnalysis is huge. If you haven't subscribed, though, my personal favorite is you guys just have the drone shots of all of these things, with the, especially on the Oracle co-located one where you're like, it's Oracle here. It's just really interesting. It'll give you a really deep knowledge just on natural gas turbines. So you said it. And I think me as a dumb generalist, the thing that worries me is like, look, GE Vernova, who provides a lot of these turbines, the stock has been a screamer. I mean, I believe the spinoff from GE happened in 2024. It's like a six-bagger since the spin. The stock is up 1.5 times this year. So I'm not saying like, hey, I'm scared to buy a stock that's gone up, though. That is always a little worried. I guess the thing with GE Vernova is what I have heard is, hey, these wind turbines, they are complicated, right? But pricing is going through the roof because the demand is crazy. And what I kind of worry about as a generalist is twofold. A, if the demand pauses, and I do want to talk a lot about AI capex, but B, I believe pricing is also going up because GE and it's kind of an oligopoly, and the other people who make it are like, we don't know if we can trust in this demand. So they've actually held back on building new plants, bringing new supply online. So they've got this beautiful, beautiful thing where demand is through the roof and they're not bringing supply online. Like, how long can that really hold, right? At some point, somebody's gonna be like, I need to bring a little bit more supply online. And once that happens, the floodgates break. And you worry you're buying into a super cycle, and there's two methods for it to break. So I knew I threw a lot out to you, but I'd love to just get your overall thoughts on that.
Yeah, sure. So gas through the roof, you said it. However, I would say there's two types of demand here. One is the big turbines, again, 500 megawatt per unit. Those are mostly serving the grid. In a few select very large data centers, like Meta, for example, talked about building an on-site power plant. But mostly it's to serve the grid. So it's still related to data center growth, but it's for a broader use case. Now you have another use case, which is deploying turbines on-site for time-to-market purposes. And what is interesting is that the dollars that flow to these turbines are actually, to some extent, not net new dollars. They're taking market share for something else, which is the diesel generator market. So actually, what you could see, and what you're starting to see, if we take the Abilene, Texas data center as an example, I look at satellite pictures, I don't see any diesel generator. And what I understand is that they're going to be deploying those turbines maybe at first for on-site power, but then as grid power comes online, they're going to be using those turbines for backup. I think you're seeing that same pattern with the Memphis data center, where Elon brought online those smaller turbines, again, which are much faster to scale up, which can be manufactured at scale, they're factory made. He first uses those turbines for on-site power, and then as grid power is built and they have a substation and such, they use it as backup. And so what happens is that the dollars that typically flow to diesel generators now flow to turbines, which serve initially as primary power and then as backup.
Let me just a question on that. Again, you are the data center expert. I'm not. But when you're building these big wind turbines and backup, and you had a great piece. I was so fascinated by the piece on intermittent power issues at data centers and their impact on the grid. We can talk about that later. But when you say, hey, you're making tens and hundreds of millions of dollars of investments into these nat gas turbines, right? And they initially serve as primary power, and then they're eventually serving as secondary power. And this might blend nicely into our capex discussion at some point. But when I hear that, I say, oh, you have a rush right now, right? But when you're spending hundreds of millions of dollars on something that's going to end up being your backup power once like the grid's kind of online, that doesn't seem sustainable, right? Like, yes, it's sustainable when you need to get stuff up now, but when you're planning your 2027, 2028 data center, at that point, aren't you kind of looking and saying, hey, we're going to be connected to the grid. Maybe we don't need to spend hundreds of millions of dollars on these giant turbines. And also, there is the discussion of as batteries get better, like maybe you need less backup sources. It just strikes me as if these are eventually going to be backup sources, it sounds great in the near term. And obviously, it sounds like diesel generators are really up a creek. But, the medium to longer term outlook for these strikes me as a little bit murkier.
Data centers have been deploying backup forever, diesel generators. And if you think about it, most of the time, those are stranded expense, right? They never actually serve. Like, if you normalize the cost of power in terms of how many hours they run per year for these diesel generators, it's absolutely high. Like, we're probably in the 1,000 per megawatt hour. So those are not economical purchases. They serve when you have a blackout. And so, for example, in Spain, a few months ago, there was this horrible blackout.
Yep.
The data center industry was, to some extent, I would say, I don't know, proud. I don't know if that's the right word, but just because they were actually able to navigate through that event.
You've got to be very careful because you're the data center industry. You're like, don't worry, guys, we had 100% uptime through the blackout. And then you're like, hey, the hospital down the street was offline. Granny was sitting in a 100-degree depression. I think that answered it well. I do have some more questions there, but let's go to the overall AI capex. You guys published a piece. Did you have something else, please?
Yeah, I want to flag something else, which is that so the thing is that today it's all about time to market, but as the market matures, like some of these, or maybe think of it this way, it's obviously cyclical. So right now it's the upcycle, so time to market matters above everything. But then as we get into the down cycle, which for sure is going to happen at some point, you're going to see companies turning cash saving mode. When they do that, they're not going to be contracting new cloud capacity or much less. They're going to be using their existing footprint, which basically means taking training GPUs to serve inference. And so what if you build a training data center with no backup at all, because uptime doesn't matter so much for training data centers, and then suddenly you have a down cycle and you want to save money. So your inference service, you want it to be high availability. So like that's also why it matters to have backup. Like that's again a decade-old rule for the data center industry to have backup. I just think you just shift from diesel to gas basically because it serves as an initial purpose of on-site gas. Yeah, sorry, go ahead.
No. Hey, that's fantastic to think about. And obviously, when I asked the question, I wasn't framing it as hey, these guys always need backup power. But I guess my push to you would be, right now they're doing it with the nat gas turbines because you do the nat gas turbine, it serves as your primary, and then you can use it as your secondary once you're plugged into the grid. If I was planning in 2028, right? Let's say I had something in 2028 and I had a hookup to the power grid in some way in this thing that's coming on in 2028. Would someone be planning that 2028 power plant with the nat gas turbines? Or would they go back and say, hey, obviously I need backup. Nobody's on that. But would they go back and say, hey, in 2028, battery's much better, so maybe I can store a lot. And even if I don't want to rely purely on battery, diesel is, as you said, it's always been the backup. It is so much cheaper than nat gas backup. Should I just use diesel plus battery as my backup instead of buying these, giant, super expensive nat gas things because I don't need a primary anymore?
So first of all, I would disagree on cost. I actually think it's pretty similar. Nat gas.
Oh, is that right? I thought diesel was significantly cheaper.
If you look at the diesel engines, they're actually very similar to the nat gas engines. So, for example, CAT has both a diesel engine and a nat gas engine. They're pretty similar, roughly same pricing. Okay. Now, again, as I said earlier, you have basically two types of on-site gas power for these deployments. You either have like what is called reciprocating engines, which is basically a giant car engine, 3 megawatts, 4 megawatts per unit, and then you have the turbines, aeroderivatives, which are like 30 megawatt per units. You're seeing both today being used. I'm not exactly sure what's going to be the share, but both seem to be getting a lot of traction, maybe slightly more on the turbine side. But anyways, in both cases, actually both the turbines and the RICE engines have a roughly similar cost structure. It's expensive, to be clear, but it's not like a surge versus diesel. So in terms of cost, it's roughly the same. The difference is really about site selection. Like basically you need to be near a pipeline. That's the only difference. You didn't need that before. You could just build a tank on site for diesel, whereas now a site selection criteria is having nat gas access.
Perfect. And I actually do want to come back to site selection criteria. Let me back up a second. CapEx, you guys published this great piece on, it looked at the 5 hyperscalers basically, right? If I remember correctly, Oracle, Amazon, Google, Microsoft, and I think you guys had CoreWeave thrown in there. And you said, hey, we are forecasting CapEx. I thought the two interesting pieces were, your CapEx estimates for the rest of 2025, and especially 2026 and 2027, were way above street estimates, right? So the party ain't stopping for CapEx. And then the other interesting, actually, I'll just pause there. What are you seeing that suggests to you that the CapEx estimates for the street, which, by the way, is pretty bullish on CapEx, and I think CapEx estimates have been going up a lot as the year has gone on. What are you seeing that's suggesting that the street is still not just low, but way too low, in your opinion?
Yeah, I just want to say, first of all, that the report you're mentioning was sent on Core Research. It's only for institutional clients. It wasn't on the broad newsletter website. So sorry, guys, it's not accessible for free.
We can still talk about it, though. We can still talk about it.
For sure, of course, and we're going to do it. Anyways, why is capex about street? Well, first of all, I ask you, like, you look at sell-side capex estimates, and they're not really modeling growth versus 2025. So 26, 27, they have some growth, like maybe high single digit, maybe low double digit, but it's not a lot, right? And so I guess we go back to something we discussed last time, which is how do cycles typically play out? Is it generally slow, steady trend, or is it actually strong, steady up and then down? Yeah, I think, again, 50 years of history back me up in saying cycles tend to be like very strong towards the upside. Anyway, this is just overall, I guess, theory. Now, what we're seeing more on the ground, using our data center model, for example, we're seeing that construction starts for self-built data centers are surging. We're seeing that the leasing rates, pre-leasing, I should say, of hyperscalers are extremely high today, which, again, when you pre-lease, it means that the data center is going to be operational next year. So that's indication on next year's capex. So most of the forward-looking data center indicator points to very sharp growth in the high double digits, which tracks pretty well with the numbers that you saw, which is like high double digits growth for hyperscalers and way ahead of street. So it's just like that. Those signals are clearly don't show capex being stabilized at high levels. They show capex going up.
And I mean, this is up, right? Like from 23 to 24, capex was up 50%. From 24 to 25, another 50%. You guys have, I think, only 35% to 40% growth in 26 and like 25 to 30% growth in 27. At that point, these companies are eating the world, right? Like just those 5 companies, I think you guys are saying in 2026, over $500 billion of capex. So I unless you have anything to add there, I have some questions on that. But if you want to add anything, I can just pause there.
Yeah, I mean, again, like all the signals go up, so we're just seeing these companies like committed to invest. And if you think about like, I mean, we can talk about the drivers. Maybe we can do that after. There's a couple of ways to frame what's driving the market. But I would just say, yeah, like we don't see anything today that would suggest they're slowing down. And also, I do want to emphasize that our report was actually sent before earnings. And the early indications that you saw, the best one was from Meta, where they basically said we're probably going to add roughly the same dollar amount on capex, which suggests plus 30 billion year on year. So they're spending 65, 70 billion in 2025. They're basically saying we're going to be close to $100 billion by 2026, soft guidance, right? So like that's the first indication from management that we've had. It clearly goes towards what we have, which is actually in terms of dollars amounts, the growth year on year is going to be roughly similar.
But so you've got accelerating spend. And I mean, these companies are spending at levels that in terms of as a percent of the economy, I don't think we've seen since kind of the railroad buildouts in the late 1800s. I could be wrong. It's not like I've got my fingers on all that kind of, but I mean, it's going to be over 1% of the economy really, really quickly, right? So just high level, is there, obviously, it's not accelerating because we're going from 50 to 35% growth. But I think no one would fault me if I said, hey, it's not exactly diminishing when you're talking numbers this big. Are there any worries about signs of diminishing ROI yet?
Yes and no. I mean, if you take a simple view of the balance sheets of these companies, like you're seeing definitely the sort of revenue to assets are going down for folks like Amazon, for example. And if you compare revenue to assets for these companies versus a CoreWeave, for example, you're seeing that GPU-only business model clearly has a lower asset turnover, which is, I guess, is a way to say returns are going down. But on the other hand,
that's not fair, though, right? Like you are fine. You're going from Microsoft, where they were selling capex-free software licenses, right, to this heavy business. Like, yes, it's going to be lower ROIC at lower whatever it is than the software licensing business, but it doesn't mean the returns on capital aren't incredible.
The returns on capital from the estimates that we've done, they're decent. They're not as good as typical Azure business, for example, which was very high margin, but they're pretty good regardless. And one thing, it's one of the big questions is what's going to be the life of these chips, the useful life of these chips.
That's actually my next question. Do you want me to? Do you mind if I frame it? Because I did a lot of work.
Go ahead.
So, look, if you talk to bears, they will tell you, Jim Chanos, and I hate to pick on him, but he's got two prominent tweets in his last like 5 days on it. He says, hey, Microsoft's, I think the one that really jumped out to me was he had a tweet that said, hey, Meta is depreciating their entire useful life at 11 to 12 years. And a lot of that is GPUs, which they're depreciating, I believe, at 3 years. And there's lots of debates on shouldn't you be depreciating GPUs faster? And I think he kind of missed the point. But he's basically saying, hey, if Meta is building all these things and they're depreciating them at, his best guess was 11 to 12 years. He thinks it might be 20 years if you do something. Are these guys, I mean, it's basically saying not accounting fraud, but are they overstating the returns on investment because you should depreciate these at 5 instead of 10, so you're actually way overstating the investment? And I'd love to get your thoughts on the depreciating useful life that you kind of so teed me up to ask you.
Yeah, so just top of my head, the accounting depreciation that we have today is about 6 years. Meta is 5.5, if I remember correctly. CoreWeave and Oracle are at 6 for servers. So the big risk is what if from 6 years you go to 4 years? There's a couple of ways to think about this. First of all, we can look at empirical evidence. The best empirical evidence is the HPC world, so high performance computing. Some of that stuff is pretty public, right? If you think about the top 500 supercomputers, some of those have been running for over 6 years. Typically, what you hear from the HPC community is for 5 to 6 years useful life. So I think when you use empirical data, what has happened historically, it's tough to make a case that this is going to be that 6 years or 5.5 years, whatever, is not an accurate measure, right? So that's the first thing I would say is it kind of makes sense based on the signals we've seen historically. Now, you could also argue that we're running these systems at max power these days. We're just doing more crazy stuff, I guess, with these GPUs. Obviously, we're trying to sweat every single watt out of these GPUs. Like the whole point is trying to utilize them as much as possible. As such, you could imagine maybe they're going to be dying faster. It's honestly it's anyone's guess at this point. Like I just cannot know what's going to happen in the future. Again, just looking at historicals, 5 to 6 years seems okay, but then I do think it's a risk. And if it's 5 instead of 6 years or 4 years instead of 6 years, then I think what's going to happen. We had a post on Oracle showing that the very large OpenAI type contracts. Actually, if you look at how they work, the margin that they get out of it is very high. We estimated about 40% EBIT margin just on a project basis, to be clear. So that doesn't include all the structure costs and such. But on a project basis, this is a very high margin project. But now, of course, if actually the useful life is 4 years, then they're going to book a massive write down in a few years, and they're going to have maybe one quarter with like minus $10 billion of loss if you're accounting. So
just what strikes me is like you said, hey, useful life is kind of 6 years. If you go from 6 to 4 years, like maybe you overinvested a little bit, but it's not the end of the world. I think the differentiation is if he's right and they're doing useful lives of 12 years or 20 years, like that is the crux of the bear tweet. And if you did a useful life of 12 or 20 and then you write it down to 4, well, then it was a disaster, right? But what you're saying, if it's at 6 and it's 4, I don't think anyone's sitting here saying, hey, this giant $100 billion data center build, it's going to be completely useless within 5 years. So I'm kind of with you. Now, there's still the questions on return on investment. Let me just ask that, the returns, you said the returns on capital are good. How do you guys measure the returns on capital here? Because to me, like, you do have the issue, there's the famous thing with bank financials. The scariest thing in a bank is a fast growing bank, because if it makes $1 of loans today and then $500 of loans 2 years from now, next year, and then $50,000 of loan 3 years from now, their metrics are going to look great, but that first dollar loan might be terrible. And you kind of don't know it till you level out. And then you say, oh my God, like we've just been fooled because all the new loans aren't paying off. These guys are accelerating capex so fast. How are they measuring their current return on spend, right? Because they're spending $350 billion this year. That's not even coming in online for 12 months. So how do they know that they're getting this great spend? And it's not just, oh yeah, the first 10 billion was great, but the next 350 billion was just crazy.
Yeah. I mean, it's basically the CoreWeave business model, right? Like the bears are looking at debt and saying this is the worst business model ever. And the analysis that we've done, which we actually posted a report that was pretty positive on CoreWeave. To be clear, we don't provide financial advice, but we just looked at the trends, and everything to us looked actually much more viable than many people were suggesting. And the way we do it, we just build a project by project analysis, right? And so actually we built a comprehensive model about a year ago called the AI Cloud TCO model, which we actually built for someone building a GPU cloud, literally. And so we feel like very good about all the estimates that we have here. And what we did is we just estimated all of the different capex related costs, all of the different opex. We went extremely deep in the rabbit hole to model like every single line item. And look, what we're saying is that there's a few things that impact your returns. Of course, like you want to have low data center cost. Of course, cost of capital matters a lot as well, because many people in the neo cloud industry have a very high cost of capital, right? Like a year ago, it wasn't unusual to see like 50 to 20% cost of debt, cost of equity probably also in the 20% plus. I think it's going to get down because some of these companies are getting more and more mature, especially CoreWeave. People are much more comfortable lending to CoreWeave at much better rates. But yeah, anyway, so there are a lot of these assumptions that are baked into the business model. And if you actually are able to optimize on your OPEX, on your cost of capital, and you can also optimize on your CapEx to some extent, which is something we flagged that Oracle is doing with networking. They have a really good networking configuration to serve very large clusters, enabling them to have a lower CapEx than others. That can actually, all of these optimizations taken together can take a business that for random neocloud, it may be, I'm making it up, 5 to 10% ARR to a 25 to 30% ARR business for Oracle. Anyway, the point being, to answer your question, they're thinking about this on a project basis, just like we're doing. At least that's my understanding. I might be wrong. But I think the best way to think about this is because there's so much upfront capex, you just want to know like what are like your likely returns. And that's also why you see a lot of these big hyperscalers signing much longer contracts than the average market rates. I think from CoreWeave disclosures, from leaks that happen by the information and Reuters and whatnot on OpenAI, it's pretty clear that they tend to sign 4 to 5 year contracts. And when you sign a 5-year contract, basically you have a guaranteed ARR, unless something goes wrong, of course, or OpenAI fails and whatnot.
Just on CoreWeave, just when you said, hey, you published a report that was positive, I wish I really looked at that IPO for a while. And I was like, man, this IPO, you get an IPO that's just really shit on. It launches low float. Like we've seen this a few times with ARM and especially with ARM. And I really looked at it and then the stock was up 3x a month later. I was like, gosh, damn it, Andrew, you swore. But I do want to ask you, and we're not making financial advice. I'm not even talking stock price here, but CoreWeave, you heard lots of bears, especially at the IPO time. And even now, a lot of people will say, hey, the stock price is completely inflated by a thin float. There's lots of, pod monkeys trading around with bar rates and everything. And just on the business, it jumps out to me that this business was really spun up in large part because Microsoft was so desperate for capacity that they entered a huge deal with them, Microsoft OpenAI. And Microsoft has said, hey, we're not doing that deal again. We're trying to do everything on our own, right? Look at this company. Their CapEx spend, even at their level, is a pittance compared to their larger peers. Their larger peers obviously have other business models where they can subsidize, they can go build a new data center knowing, hey, most of it's going to be taken by our core internal processes, and then we can fill the books with third parties if necessary. CoreWeave doesn't have any of that. So I just love to ask, again, not the stock, but just the CoreWeave business, kind of why do you think it makes sense, and why are you guys still kind of positive on the business versus kind of these giants that are playing in a similar field with other advantages?
Yeah. So basically, if you think about the market for very large contracts, OpenAI, hyperscalers, Anthropic, these guys, it's basically a commodity because what these clouds are providing is bare metal infrastructure. So what you have to do is building a data center, putting some machines in there, assembling the machine through networking, but there's no software layer on top of it. There's no like technical differentiation, or there's to some extent, but it's really much lower compared to what we're used to see from AWS and Azure and others. So barriers to entry are much lower. And if you think about it, okay, it's a commodity. How can you win? There are two ways to win. One is long-term is having the best cost structure. But actually, that's not what matters today, because what matters today is speed. That's really the thing that matters, because that's what these big end users want. That's what OpenAI wants. That's what Anthropic want. They want the clusters as fast as possible. So basically, you got to optimize everything for speed. And this is where you look at CoreWeave's strategy, and they've actually done some stuff which enabled them to beat everyone else at speed. They contracted over like 2 gigawatts of power in roughly 2 years. They had to take on, of course, material financial risk and such to do that. But for example, they've been working with those crypto miners, which no one was considering back then. CoreWeave was among the first to sign with a miner, and these guys, they have the power right there. They have the substation, everything is in there. So you just need to trust that the miner has good enough contractors to actually build a data center, but the time to market is unrivaled, right? So if you think about the challenges to build a greenfield data centers, well, CoreWeave said no. I just want to go brownfield, and they have a couple of others like Kirisa and Tech Fusion, a couple of other partners that build brownfield data centers at an extreme speed. And in terms of cost, honestly, it's probably not the best cost structure. And I think they're trying to optimize that increasingly as of today, because now they scale and they have gained sort of that trust from many partners. That's why they acquired Core Scientific, is because that way they're more vertical. They can own the infrastructure and such. But they really scaled at an impressive pace in 2023 and 2024. And so if you think of I want to add something. If you think about the time to build a data center, you ask most people that have been in the industry for a while, they're going to tell you those are 2, 3, 4-year projects, right? That's the time it takes to build a data center. And if you look at the listed companies, think Digital Realty and others, that's what you see on their statements, is that when they start building, it becomes real, it generates revenue, whatever, 2 years after, 18 months, sometimes slightly more, sometimes slightly less. In CoreWeave, if you look at their deal with Core Scientific, things are moving faster, right? They're doing that stuff in less than a year in some cases. And so that speed is really what enabled them to gain those contracts. And so really, I think they took some pretty innovative ways to think about infrastructure that are much more optimized for AI, whereas everyone else was still in the cloud mindset. And look, I'll give you another example, which is what Oracle did in Abilene. I think
can we pause on Oracle? Because I actually do want to come back to Oracle. I'm very interested. Do you mind if I ask one more on CoreWeave? Just I heard a lot of interesting things there, but if I was a bear, I would say, hey, what Jeremie just described was they took on risks that no one else was willing to do, and they really emphasized speed. And that is, in an up cycle, that is everything you want, right? But one thing Jeremie said is there is always a down cycle. Like whenever back in 2022, when people were just first starting to talk about shit, everyone said, hey, even NVIDIA, there's a down cycle. And all the NVIDIA like long timers, they might have missed the big move because they were like, things are starting to look good. That's when you sell, because there's a down cycle coming, and they missed it. If CoreWeave they're basically optimized for an upcycle. Like, aren't they going to get crushed the moment a down cycle comes? And then all of a sudden they're committed to, hey, all they've done is accelerate and take as much as they can, and they're delivering it as fast as possible. And then a down cycle, even if it's a blip for 6 months, come and they're just completely stuffed. Am I crazy to think that?
You're not crazy. And actually, I think that applies also to Oracle, which we can talk about in a bit.
Yes.
But yes, 100%. It's a lot of risk. And the simplest way to frame the risk is your longest GPU contract is going to be 5 years. Your data center deal is going to be 15 years. So if you cannot replace those GPUs and find a new contract, you're stuck with 10 years of paying rent to a data center operator without any revenue. So that's the simplest way to frame the risk, which I agree 100% exists. So you can think of it as a bet on the underlying companies, right? All these companies likely to need capacity in the future. I think that's the way the bet is framed, right? And so if you think about, I'm exposed to OpenAI, so both CoreWeave and Oracle, the way you think about it is OpenAI is not going to fail. OpenAI is going to need GPUs forever because they have a business model that structurally requires GPUs on the inference side, and also they always have big training requirements. So that's the way you can frame it. Is I'm betting on the AI industry to be a long-term consumer of GPUs, a long-term consumer of power, and as I secure power, as I build data centers, I can renew those contracts over time.
I actually have some more questions, Power, but let's go to Oracle. You wrote a piece on Oracle, and I'm sure you didn't see, but my last book club, I read Larry Ellison's biography from 2002. And as I was reading it, in the back of my mind, I mean, Oracle stock has been on a heck of a run this year, right? And as I was reading it in the back of my mind, I was kind of thinking, hey, Larry Ellison managed somehow, as a late 70s, early 80s, I can't remember if he's in his 70s or 80s, somehow he managed to catch the AI wave. Now, he wasn't like crazy early, but in 2023-ish, he saw where it was going. He made a big bet, and boom, this man who's called so many trends calls this one again, and Oracle's really benefiting right now. So I just want to throw that background out and ask, just like, what is Oracle's AI strategy, and why is it working out for them?
It's CoreWeave. They're taking the CoreWeave path. Oracle's strategy is, I'm going to use my balance sheet to get the largest contracts. They're using their investment grade signature to get, call it, normal contracts. Let me explain. Basically, CoreWeave, one of their issues was that because they're not investment grade and they're not a reliable hyperscaler and such, they struggle to get capacity from reliable data center operators. Sorry, when I say reliable, I mean experienced guys, again, the Digital Realties, all of these people that have been building forever, that have a lot of land, that can deliver power. So definitely these guys, they love working with hyperscalers, less so with CoreWeave. Oracle fits in the hyperscaler category, so Oracle can easily get capacity from folks like Digital Realty and others. So that's one advantage that they have, which all hyperscalers share, to be clear. But what Oracle did in the Abilene side was basically going CoreWeave, was I'm going to do a massive bet on this company, which by then, like if you look on paper, who is Crusoe? Crusoe is a crypto miner that never built a data center for like uptime related, like traditional data center purposes. They built mines, and I do think they had amazing engineering teams and such. They're a great company, but back then, if you look at it on paper, it's betting on Crusoe was the same as betting on other crypto miners today, right? And Oracle took that bet. They signed this contract, and if you think about it, it's the same situation. They're getting a 5-year deal with OpenAI, but the deal they signed with Crusoe, I think the leaked numbers were like 15 years, right? 15-year deal. It's probably $15 to $20 billion over like those 15 years. So if the contract fails after 5 years and they cannot renew it, they're stuck with like 10 years of paying $1 billion a year or more to Crusoe. So it's the same thing, right? It's taking massive financial risk, betting on the success of these companies. And if something were to happen to OpenAI or to the overall Gen AI industry growth, you could frame a future where Oracle isn't very happy, let's say.
I guess it's easier because even in 2023, this is a $300 to $400 billion EV company. So they are making a big bet, but CoreWeave was existential, like this works or the company zeros. And it's kind of interesting. Oracle made that bet, and it was not purely existential, right? Like Oracle would exist if this bet had gone in flames. But at the same time, CoreWeave, as many people pointed out, they took the optionality bet, right? This works and we're 100x. This doesn't work and we're 0. Oracle, I mean, they had both sides of that bet, right? If it went up, they'd benefit as they are benefiting. The stock is up, probably 50% this year. But if it didn't work, they were on the hook for all those payments. And then they're sticking around and they're saying, hey, okay, we're the largest data center people in the world. We've got all this excess capacity. And we're going to have to lease it for a song. Anything else on Oracle?
Yeah. I was going to say, like, I guess you could frame a difference with Oracle, which is that they already had an existing cloud business. So there's always the hope that by signing a gigantic deal with OpenAI, you also incentivize OpenAI to use your CPU-based infrastructure, which I'm sure the spending that OpenAI does on Azure for traditional cloud services, I'm sure that's fairly high. Again, like to manage like 700 million weekly users. It's not just about models, it's also about like data storage and traditional sort of CPU front-end processing and whatnot. So that's also, I guess, the hope that Oracle has is by signing those GPU deals, they can also grow their Oracle cloud infrastructure business, which was like 10x or more smaller than other rival hyperscalers. So I think Oracle, like if you look at the history, they made this very bold bet on cloud in 2016 or 2017. And it turned out okay, but not that good, right? Like they were still lagging like way behind other hyperscalers, growing decently, but not like triple digits at a pace that was enough to catch up with the others. So it makes sense also from a strategic perspective to just increase the size of the cloud business and hopefully upsell some services. And what we've said in the report is that we don't see a lot of evidence that this is happening today. And we don't think it fundamentally has to happen. Because it's very easy to sort of connect GPU infrastructure with another cloud provider. So we're yet to see a meaningful benefit of co-locating or having on the same cloud GPUs and CPUs. But it's always a possibility, right? So they have this option. I don't know if it's going to happen or not. I don't think so, but it could happen. And if it does, of course, very positive for their cloud business. and
I
software.
think the thing that's coolest about Oracle is just like high level as someone who's kind of not a specialist in this, but Larry Ellison, again, he's in his, let's just call it 70s. I can't remember his exact age, but Oracle is late to the cloud computing party. I mean, you just said they started in 2016, 2017. I mean, AWS starts becoming the driver of Amazon in 2012. Microsoft with Azure, they are late and they missed the boat, and they're basically, you can tell me if I'm wrong, they're an also ran there. And Larry Ellison in his 70s says, hey, we missed the boat in cloud computing. Hyperscaling starts taking off in 2023. And look, there were plenty of people at the time who were saying, hey, this is a bubble, too much capacity is already getting built. Where are the returns, all this sort of stuff. And Ellison says, and I say Ellison, Oracle, but I think Oracle is Ellison. They instantly go all in. And when I read that Oracle autobiography, it fits totally with his personality, but he goes all in and he hits it again in his 70s. It's just like crazy to have that mental flexibility and that forecast of the future. I want to ask you a few things about power, but any last thing on Oracle or anything?
No, I think the way you frame it is great. Like, yeah, definitely that was a very bold bet, paying off pretty nicely now.
Power. So it still strikes me that, and we had this discussion in our first conversation, but it still strikes me that for the most part, all these data centers are going up. And I don't want to say only domestically, but the US is the hotspot for data centers. And you can tell me if I'm wrong. There are big data centers in Asia. Stargate 2 is in Saudi Arabia, I think. I can't remember. But for the most part, they're going up in the US. And they're going up, not in New York City, but they're going up pretty close to, urban areas. They obviously connection, latency, all that sort of stuff is power. Tell me if I was wrong on any of that, but when do we start seeing data centers getting built in crazy places, right? I think there was the Elon Musk tweet about putting a data center up in space. I doubt we're getting one in space, but you can see the appeal, right? You don't have to worry about power as much because you don't have any heating components, any heating worries if you're in space. I'll take one. Alaska, right? We don't have to go build in Antarctica or somewhere but there's infrastructure in Alaska. It's really cold up there. There's a lot of access. We talked about natural gas. When do we start seeing a big data center get built out in Alaska, where land is cheaper, labor is cheaper? I'm asking, I see you laughing because it's clearly a silly question, but why is it a silly question?
No, I don't think it's actually silly. I think it could happen. Generally, the problem that you see in more remote locations is labor. Can you actually get thousands of people on site? Are the logistics good enough to be able to handle a project of that scale? That can be one of the big issues. But overall, I think what you said at the beginning is inaccurate, because I do think we're already seeing very large data centers pretty far away from population centers. West Texas, I think, is already growing. Look, Abilene, I mean, you could say Abilene is a city. It's not too far away from Dallas. But I think we're going to see a few massive data centers in West Texas in the next 2-3 years in more remote locations. I mean, you could also say like Ellendale, North Dakota. Sorry, Applied Digital guys, but that's really far away from everything.
Ellendale's the Applied Digital site, right?
Yeah, correct.
Yeah.
The logistics to go there are pretty insane. It's pretty tough to go, but yeah, I mean, it's still possible. So I do think we're seeing already a move away from those metros. A lot of these data centers are being built in areas that are just more remote, right?
But even there, and it's still in the domestic U.S., right? And getting out to Ellendale, I haven't looked at the map, but I'm sure it involves a pretty long car ride and a flight into a very small airport. But Alaska, or I don't think I said Alaska because my first thought was, hey, super up north Canada, right? But super up north Canada there's nothing built out there, right? Mm-hmm. So you would have to build out the gas pipeline, and you'd have to build out a fiber connection. Alaska has all that, right? Now, I'm not saying it has it in what you need for a 500 billion Stargate or something, but it's got a lot of that. And if it's got a lot of that, you can lay some more fiber and stuff. I'm just surprised, in Alaska, I know there were a few people talking about the Nordic regions, and I know there's some smaller ones out there, but I'm an outsider, but I'm surprised that you haven't seen something huge getting built in something where a little more out the way, and you start saying, hey, we're spending $6 billion in this. Let's pay the data scientists an extra $5,000 to fly out there when we need them or something,
Yeah. I mean, you might have seen an announcement, I think 2 or 3 weeks ago from Crusoe, saying they're going to build a massive data center in Wyoming. I mean, still, I guess it's close from Cheyenne, but still pretty like far away, I would say. But yeah, overall, I definitely expect to see data centers going to more remote locations. It's already happening today. I think it's going to happen more. I haven't looked at Alaska specifically, so I can't really tell you.
I was just throwing out there because
actually, one thing we can touch on is there was a question on Twitter I saw that was asking about the Permian Basin. And so I would say it's just a thought. I haven't looked at Alaska again, but the issues with the Permian Basin is that they don't have a grid infrastructure.
Yes.
And ideally, you want to build grid infrastructure because it's lower electricity costs, it's higher uptime. Grid is actually the best power you can have on site. Ideally, you want to have a grid connection. Fully islanded data centers are pretty expensive. It works out, again, as we discussed before, for a fast time to market, but then this equipment serves as backup, and you want to have primary power coming from the grid. Permian Basin doesn't have a large electrical transmission infrastructure. There's a project going on, but it's going to be like 5 years out or something. So maybe that's one of the reasons why Alaska isn't considered today, but I may be wrong.
Let me ask a general question on power, right? It strikes me that everything, like power is the limiting factor. It is the component. Obviously, time to build these things, but it's been a race for power. And you've seen this in the stocks of all the power players have gone off. And I just want to ask, I think we touched on this in the first podcast, but I want to follow up again. Like, if I look at the history of things, power efficiency tends to improve over time, particularly when it's a limiting factor. And I would point you to, the biggest improvements in car fuel efficiency come after big oil spikes, right? Airline fuel efficiency. I believe jets today are depending on your source, 50 to 75% more fuel efficient than they were 30 or 40 years ago. Homes today, they consume a lot more power because we use a heck of a lot more power, but they are much more power efficient. Just want to ask, like, at what point right now we're in the rush, right? But could you see a world where, hey, there's still a rush for GPU capacity, but 2 years from now, they say, all right, demand is still growing, but it's not growing exponentially. Let's optimize on power. And then all of a sudden you have a world where a lot of these data centers, not that they're stranded assets, but you were building 1 gig data centers, 2 gig data centers. You say, hey, now that we optimize on power, it turns out we need 50% less power. And all these data centers are sitting here saying, oh my gosh, like there's just no need for us because even though demand's growing, like we just took our costs down because it's the bottleneck, and physical bottlenecks tend to get solved over time. Does that question make sense?
Yeah, of course, makes a ton of sense. I mean, it's always the big fear that we're doing a massive oversupply and that all the demand is going to go away, which is completely possible, to be fair. It's a scenario. I mean, we can look at the cloud computing world, I guess, maybe as a proxy, where you've seen electricity cost as a share of revenue for these huge cloud providers go down over time. There seems to be a moment where it doesn't really go down that much at some point. And if like one thing you can do is like just look at Azure revenue growth and look at what they've published in their ESG reports, for example. And you see that it actually tracks pretty well. They're growing revenue a lot. They're growing electricity consumption a lot. And basically, my point being, even if the unit of compute itself is improving, so the CPUs, in this case, especially the GPUs, are getting more and more powerful. Like this is kind of the Jevons effect, I guess, which is you're just going to sell more with those GPUs. But like generally speaking, okay, let me put it this way. Generally, when you look at the GPUs over time, if you look at NVIDIA's roadmap, of course, pricing goes up for their GPUs, but power costs also go up for the GPUs. And actually, you see power and price tracking correlating pretty well. And that's because if you look at Blackwell, like the reason Blackwell is more powerful, there's a couple of things, but one obvious is that it's actually 2 compute dies, it's not 1 compute die. And so when you have 2 compute dies, you don't double the power, but it's actually close to it. Then you have system level improvements and whatnot. But the point being, at the hardware level, you actually have a pretty good correlation between price and power of the system.
Can I just slightly push back on that? I mean, It does strike me that for the past, let's say 50 years, like since the dawn of the computer industry, power has never really been a constraint, right? And by power, I'm using electricity. I'm basically saying electricity costs, like the cost of power. I'm sure people would have loved to get more power into the GPUs and everything, but you could build it with the assumption that basically you were kind of treating your electricity and power costs as free, right? And obviously they were not free, but they were so low fragment. now power is actually the bottleneck, right? Like I think we would have a lot more data centers, and if people could just get access to the power and electricity, we would have a lot more capacity right now. As we go into a world where power has been the bottleneck since mid 2023 for 2 years, do people start does NVIDIA's next project, what they're releasing in 2026, does it optimize for this power constrained world? So actually GPUs go up, but maybe a little bit less, but power usage goes way down. Does that make sense? Is there any roadmap there?
I mean, if you look at NVIDIA's roadmap, what they're doing is, as I said, price and power track pretty well, but actually the throughput of the chip goes up a lot. So in terms of throughput per power, energy efficiency goes up a ton, to be clear. If you think about the system level improvements, it's all about having more GPUs working together and whatnot to deliver more output with a roughly similar power envelope. So yes, NVIDIA is very clearly trying to push power efficiency. Now, the reason they're doing it is mostly because you can use those added tokens to generate more intelligence. And so that's where we go back to the debate of Jevons paradox, which is, what are you going to do with your extra compute power? Are you going to use it to save on costs or to increase intelligence? And the path that the leading AI labs are choosing is to increase intelligence, because I think what they're saying today is that the best way to monetize LLMs is to have the single best models, very simply. Anthropic has the single best model at code, and you're seeing everyone use Anthropic models. And then if you sort of go down the stack and start looking at the market for cheaper models that have pretty good price per intelligence, actually building those models is much cheaper because you can use techniques like distillation, which is you use one model to generate whatever synthetic data and such, to distill intelligence into a smaller model. All the AI labs are doing that. And so this is where you get into much more competition, right? If you think about the market for these mid-level models, there's a lot of competition from the Chinese, the open source firms, the big labs. But really, the moneymaker is the frontier model. And so that's why we think, because of this specific structure, there is an incentive to always use the extra computing power that you get from NVIDIA to increase the intelligence of your model. And so you can frame it this way, in terms of physical constraints, yes, price per GPU goes up, so power goes up as well, that's pretty linear. But then the intelligence you get, the compute power you get from NVIDIA goes this way, much higher. And the intelligence you get out of the models also go way, way up, more in an exponential curve, I guess. Does that make sense? Any pushback?
It does make sense. It does make total sense. There are some follow-on questions I want to follow there, but I'm aware of time, and I want to ask one last completely unrelated subject. You guys had a report on robotics that I thought was very interesting. So I'd love to just pause here, and you can give overall thoughts on robotics, and then I had some specific questions.
Yeah. I mean, basically, the idea behind the robotics piece was we just wanted to sort of provide a framework to help people understand the robotics market. And so we added these classifications of levels of autonomy, which we've seen on automotive, we've seen on LLMs.
I loved it because you instantly knew, right? You had level 0 to, I think yours went up to level 4 versus level 5 for driving. But as soon as I said it, I was like, I can equate it to vehicles. I really like that framing.
Yeah, and what we find out in our research, and maybe some people are going to nitpick on some things, because we cannot make a level that's going to make everyone happy. Some stuff, there's always some nuance at the point. But overall, what we found is that we can frame it in a way that's easy to understand. And so if you think about our levels, level 0 is the rigid robotic arm. Level 1 is the slightly more flexible pick-and-place arm. Level 2 adds mobility, so it's like the RoboDog. Level 3 is sort of a weak humanoid, and level 4 is a strong humanoid. And to be clear, again, that's an oversimplification. And I hope our robotics guys aren't going to kill me when they listen to that. But it's kind of the simple way to think about it, is that there's these different capabilities that add up over time, and are actually somewhat. There's a sort of a simple way to frame it, I guess is the point. Easy to understand for people. And basically what we wanted to do with that piece is help people understand where we are. And so if we think about level 4, which is those super humanoids, we're pretty far away still. We're still in the research phase. But we're actually already seeing level 2. People don't really talk about that, but all of these sort of mobile quadrupeds, like the robodogs, you're seeing that's actually in early production phases. And so that might be actually a trend that could be interesting in the next 1 to 2 years.
Which is the overall question I had on robotics was, how quickly do you think we accelerate in robotics, right? Because I mean, AI, maybe people are starting to get disappointed with the Chat GPT 5 versus Chat GPT 4. But if you were sitting here 4 years ago and talking about where we are with AI, I think most people would have their mind blown, because Chat GPT wasn't even out at that point. I think most people, how quickly does robotics start accelerating? Because it does strike me like Tesla, controversial, the robotics are out in the field, but you're starting to see more of the robotics get out into the field. I saw there was like a robotics fight league. Like, you're starting to see more. And once you start to see more, it tends to accelerate, especially with the AI data. So if you and I were talking here in like 4 years, do you think we're seeing level 3 out there? If we're talking in 15 years, like, how quickly do you think this is accelerating?
Yeah, I'd say currently we don't have any evidence that it's going to happen as fast as we've seen with LLMs. And one of the big reasons
are just harder than physics are just harder than anything else. Yeah.
Correct, right? And in terms of data, like there's always the data issue, which is text. We have the internet data, like trillions of tokens. It's pretty hard to generate high quality data for robotics. So that's one of the big bottlenecks in increasing capabilities. So this is being currently solved, and I do think progress is starting to accelerate. But I just struggle to see a world where it gets as fast as we've seen with LLMs, right? And so if you think about it, like LLMs, as the leaders love to say, like today you have some models that are nearly as smart as advanced university students. And 2 years ago, it was like a dumb kid, right? No offense, kids.
But I like when you say it's nearly as smart as an advanced university student, because I've given ChatGPT or whatever research projects, and I've had it spit out just like brilliant insights, right? It's digested scientific papers in half a second and spit it out in language that, I like to say, like, hey, I'm someone who hasn't taken a science class since high school. Please put it out to me in a language I can understand. And they do that. So you get these brilliant, and then I also, like yesterday, it was going again, how many bees are in blueberry? And it says, I would bet my life there are 3 bees in blueberry. And you're just like, man, on one hand, it can understand science, so advanced university student. On the other hand, it might be as dumb as my kid. It's so funny.
Yeah, no, for sure. But I'm definitely with you. Like, I'm a huge user of deep research and that kind of tools. So I think it's incredible. In terms of robotics, anyways, to go back to this, there are a few additional challenges. So I think it's going to accelerate, but not to the same extent. So I don't know. I'm not the main robotics analyst at SemiAnalysis. I don't want to make a crazy prediction. But let's say level 4 in the next few years seems unlikely to me right now.
Wait. It's funny when you look at this, and this gets more into dystopian future, or maybe we need to have a sci-fi writer on, but like, if they're as smart as university students, and you're already hearing lots of, I think it's overblown, but you're already hearing lots of consulting firms like struggle and taking consulting jobs. And then you're saying, hey, if level 4 is here, I mean, how long till it starts taking low wage, like kind of manual labor? And you're like, Jeremy, what are we going to be doing in 6 years? Like we can't use our hands, and it's smarter than us. What are we going to be doing?
Yeah, I mean, there's this great analogy. I think it's interesting where you think about accountants, like, I don't know, before Excel, before spreadsheets. And like, I've talked to people that told me, like, back then, like, people were thinking spreadsheets were going to kill the accounting job, right? And actually, you've seen accountants like go up a lot. It's just they're doing new types of work. They don't have to do all the manual calculations and such. They can let the machine do that, and they can use their brain in some other ways. So yeah, I guess that's just like the framework, I would say.
Which, I mean, the one people point to now is law firms, right? And you say, hey, this is going to take the work of a lot of junior analysts, but at the top, like, we have no lack of legal law, and legal cases are accelerating. But you do wonder, like, or there's the famous, what is it? They tried to ban the sewing machine because it was going to replace all the seamstress jobs in Britain. It's a little scary, right? Like, I tend to be pretty optimistic and say, hey, there's going to be jobs and it's going to create really new, interesting ones. But then when you start getting to, hey, you've never had something that can replace human thinking before, and you still needed a human, while it can automate basic tasks, you still needed a human to, like, go flip the French fries over and then hand them out to hand them out to the customer. And if you've got, on one hand, robots take the French fry machine, and on the other hand, computers think better than McKinsey consultant, it's like, what is left for us to do? It's
yeah, I don't know. I guess maybe more relationships, like the value of social relationships probably goes up over time, because At some point, you trust humans more than machines for certain things. So maybe that's the future. You gotta be sure to be well connected and have a good network. That's what
it's a good thing we're so handsome. That's the one thing robots can't do. You and I can hop on it and we could go be fashion models. Robots can't take that for now. Jeremie, this has been great. Look, the first one was a hit. I think this is going to be a hit. Maybe we'll have to have you on like before the end of the year or something to do like outlooks into 2026 or something. Talk about how high that capex spend is going in 2026.
$10 trillion. No,
$10 trillion. Wow. I said it wasn't accelerating. We're getting real acceleration. This has been great. I'll include a link to SemiAnalysis in the show notes, and we'll go from there.
All right, man. Always a pleasure. Thanks for having me.
A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.